Constantly developing and very important story around the collapse of crypto exchange FTX and its hedge fund Alameda Research.
One of the largest exchanges in the world, FTX, collapsed this week after a chain reaction set off by a leaked document that raised questions about the company's finances.
So what really caused this collapse? Let's talk about a little bit history first. FTX was founded by Sam Bankman Fried in 2019 and was headquartered in the Bahamas. Under Sam's leadership, FTX marketed itself aggressively and paid hundreds of millions of dollars in different sponsorship deals. FTX reached more than 1 million users while at its peak in 2021. Even institutional investors like SoftBank and Square Capital invested in FTX while it was at its peaks in 2021. So what really happened? Sam had a sister company called Alameda Research, which was a trading firm. A leaked report of Alameda's balance sheet showed that they had majority of their assets in FTT token, which raised questions about relationship between Alameda and FTX. After these revelations, CZ's CEO of Binance, who was also an investor in FTX, tweeted on November 6th about liquidating FTT, which they received as a part of initial investment deal, describing it as post-exit risk management, which led to panic selling of FTT, and FTT price crashed more than 90% in a few days. This led to the bank run among FTX users and people starting withdrawing their funds. Later on, FTX stopped withdrawals simply because they didn't have enough funds to pay their users. In the meantime, SBF resigned as FTX CEO and filed for bankruptcy. So the next question arises, where did the user funds go? According to latest reports, FTX was allegedly involved in loaning $10 billion customer funds to Alameda Research to fund risky trading bets, and out of these funds, an estimated $1 to $2 billion are totally missing from Alameda's balance sheet. Besides this, FTX was using customer funds to buy back FTT and manipulate FTT price, and holding most of its assets in the form of FTT. That's why FTT crash caused them to lose their assets and held up in form of FTT. So basically, in simple words, FTX was loaning billions of dollars to Alameda Research without any collateral, and Alameda was losing money while trading these big positions. What are the takeaways from this story and how can this be avoided? The simple answer is crypto industry needs to be regulated whether someone likes it or not. Most of the crypto exchanges are tokens, which are basically unregulated securities, and their supply is controlled by some kind of CEO, and big portion of it is locked up by the company, and they manipulate the price of token by either selling off the top or changing the supply of token, which is totally opposite to the idea of decentralization and exposes regular investors to the mercy of owners of these tokens or coins. Regulation will make these tokens or coins to share this data publicly, and investors will have a better idea of risks attached to it, just like regular stocks. And in case of exchanges, they need to be audited by third-party auditors, just like regulated enterprises, to make sure nothing is off the books and customers are secure.
What he did is he generated $10 billion in unregistered security and then just borrowed $10 billion secretly from his depositors, and then went and gambled it, traded it, spent it, lost it.
How?
And that is it's particularly impressive.
This was a short wrap-up from my side. Leave your thoughts in comment section and don't forget to like and subscribe. Thanks.